Hey, what's going on, guys? Just a few things before I start this video. If you have not subscribed to my second channel, I'll put the link below, and if you want to check out my video newsletter that I'm doing each month, check that out below. And yeah, anyways, I'm gonna do a video, and it's gonna be probably called Deflationary Headfake Scenario 1. So I have a lot of scenarios going on in my head, first of all, that we could have either a deflationary head fake, which I've stated in interviews. Two, we could have a stagflationary cycle. That's scenario 2 going on in my head. Or 3, it's going to be a Ludwig von Mises crack up boom, hyperinflation, within the next few years. And I've had these 3 scenarios going on in my head. And I think the scenario I'm going to talk about today, deflationary head fake, this is the second most likely outcome in my opinion. Once again, this is just my own thoughts. Don't go ahead and make investment decisions based on what I'm saying, okay? Always talk to your financial advisor, okay? And I'm going to chronicle the 2 other situations a bit later on. But right now I want to look at why I think it could potentially be a deflationary head fake. And if you look at what's going on, the Chinese 7-day repo rates, we see these huge fluctuations going on. And what does this remind me of? Remind me of what happened right before Lehman happened. I'll show you why and how I'm getting to this thought process. Look at the Chinese repo rates right now. This is actually June 2013. And if you look at it, it is over 1,100 basis points. Huge spike from, what is it, 400 basis points, or if you want to look at May, somewhere around 300 basis points to 1,100 basis points. Huge, huge moves. That's a red flag in my opinion. But then PBOC, the Chinese central bank, intervened in the markets, lower these rates, right? So you see some fluctuations in these repo rates, and there wasn't that much stress. But then you saw stress again in December, right? And what happened? It went from 400 basis points to roughly over 800 basis points. Huge moves. And then PBOC intervened again. And you see the same thing happen again, right? 600 basis points today, as of last night. So what does that mean? This doesn't mean that it's going to be Lehman, right? I've stated in one interview that this is going to be Lehman. Some people said, what the hell are you talking about? This is bullcrap, right? I saw comments on that video. I got rid of that video because the comments back and forth were just ridiculous. But this was my thought process. I said, okay, we see these rates going up in China, and this reminded me of what happened right before Lehman. Once again, it doesn't necessarily have to be Lehman, but I'm going to show you where I'm getting my thought process from, and I'm going to go to the book Getting Off Track again and show you some graphs right now. Okay, now let's look at this LIBOR OIS spread, which I've been talking about a lot. No one that I know covers this except me, unless someone else is covering it. But anyways, they may be covering the LIBOR scandal, but all I mentioned is in the summer of 2007, LIBOR OIS spreads. It's a measure of credit conditions, right? And it was hovering around 10 basis points, right? And then it shot up all the way in August/September. It must have been August, right? This is when I was doing an internship with a real estate company back then. And if you look at it, this went up to roughly 100 basis points, or 100 basis points. So huge moves, 10 basis points to 100 basis points. Huge moves, right? That scared Bernanke. And what he did was he addressed this problem as a liquidity problem, not a solvency problem. That was his criticism of how he handled what happened in 2007, 2008. And I don't like central planning, but this is what people were talking about. So you look at this liquidity problem here, or this is a solvency problem. He addressed it as a liquidity problem. And then what he did, he started lowering Fed funds rate 5.25%, and then it went down. But then look at this again. Doesn't this look kind of similar to what's going on in China right now? You saw rates go down, then it went back up. And then they started to institute in December the term auction facility program. And that lowered rates for a while. But then in September, when Lehman happened, these rates started to skyrocket. And the rates were over 365 basis points, the spread between LIBOR and OIS. So what is going on in my head right now? We see a lot of or we see some credit conditions starting to get a little worse in China, despite the Chinese central bank throwing money at the situation. All right, now this is from Forbes.com. The author is Gordon Chang. He's a China bear. And if you look at it, it's called Mega Default in China, scheduled for January 31st. On Friday, Chinese state media reported that China Credit Trust Company warned investors that they may not be repaid when one of its wealth management products matures on January 31st, the first day of the year of the horse. The Industrial and Commercial Bank of China sold a China Credit Trust product to its customers in inland Shanxi. I apologize for that pronunciation, province. This bank, the world's largest by assets, on Thursday suggested it will not compensate investors, stating in a phone interview with Reuters that a situation completely does not exist in the ICBC will assume the main responsibility. And it just goes a little bit on about what was going on with this situation. And if you want to look at a little further in it, we could look at what's in this article, and we could start right here. A WMP default, whether relating to, I can't pronounce those names correctly, Lanshang or Zhenfu, could devastate the Chinese banking system and the larger economy as well. In short, China's growth since the end of 2008 has been dependent on ultra-loose credit first, channeled through state banks, the ICBS and Construction Bank, and then through the WMPs, which permitted the state banks to avoid default or to avoid credit risk. Any disruption in the flow of cash from investors to dodgy borrowers through WMPs would rock China with sky-high interest rates or a precipitous plunge in credit, probably both. The result, the best outcome, would be decades of misery, what we saw in Japan after its bubble burst in the early 1990s. And then there's some other individuals talks about how a default wouldn't matter. So let's look at further into this article. That's correct, but that is also why China is now heading to catastrophic failure, because Chinese leaders have the power to prevent corrections. They do so. Because they do so, the underlying imbalances become larger. Because the underlying imbalances become larger, the inevitable corrections are severe. Downturns, which Beijing hates, are essential, allowing adjustments to be made while they are still relatively minor. The last year-on-year contraction in China's gross domestic product, according to the official National Bureau of Statistics, occurred in 1976, the year Mao Zedong died. Why will China's correction be historic in its severity? Because Chinese leaders will prevent adjustments until they no longer have the ability to do so. When they no longer have the ability, their system will simply fail. Then there will be nothing they can do to prevent the free fall. We are almost at the critical point, as events last June and December demonstrate. The PBOC did not try to tighten credit as analysts said in June and December. It simply did not add liquidity. The failure to add liquidity caused interbank rates to soar and banks to default on their interbank obligations. In the face of the resulting crises, the central bank backed down both times, injecting more money into state banks and the economy. So Chinese leaders showed us twice last year they have no ability or no will to deal with the most important issue they face, the out-of-control creation of debt. And it goes on and on and on. And the author of this article mentioned what I was trying to show, and it was the interbank rates went up. Nobody's talking about these interbank rates, but whenever I see credit conditions happen like this, repo rates go up. This reminds me of what happened 2007, 2008. Does it have to end like Lehman? No, because central banks, they react in different manners, right? Just like I was trying to say in previous videos, right? Just in sports, when you start to see a similar pattern, the defense is going to react differently because they have a scouting report. And now central banks have a scouting report what happened 2007, 2008. So it doesn't necessarily have to be Lehman. They could be aggressively going in behind the scenes to try to alleviate the problems that we see right now. But long story short, if you have a credit condition, simply pouring money, in my opinion, is not going to solve the problem, right? There needs to be more action that needs to be taken. I don't think they're going to do the right thing. regardless, whether it's more money printing or not. These central planners always underestimate the problem. And now let's get into why I think this could be a potential deflationary head fake. Alright, now you're looking at the total credit market debt outstanding, which I chronicled from time to time. And you could see that it was going up in this manner, right? Exponentially, it was expanding at like 8.8% a year from what I've seen. And then you saw this huge, not huge blip, but you saw a correction, right? This was actually a force of deflation, right? I mean, people say that we had inflation in 2008 because we printed a lot of money, but they're not looking at credit. They're only looking at money supply. Sure, money supply expanded, because the way that I look at deflation or inflation or deflation is depends on it's the increase in money supply and credit. Well, this is credit. This is the best way to analyze credit. Total credit market debt outstanding. And if you look at it, see this decrease in credit. So that was a force of deflation. But now we're starting to see credit slowly but steadily go up. But it's only going to the government sector, though. You're seeing deleveraging elsewhere. So we do have inflation going on, but I would say what we have right now is disinflation, contrary to what the Krugman school is talking about, or guys who agree with his camp. But all I'm saying is that if China has a similar situation like us, a credit crunch, then I would expect their credit to decrease, and that would be a deflationary head fake. But you have to remember, central banks are in charge. So what they could do is we could have a head fake. We could have periods of deflation for 3 to 6 months, and we could see commodities crash. We could see oil prices go down, stock prices initially go down. But at the end of the day, they want to debase the currency. They don't want to see deflation. We could have bail-ins. That could be a way to avert the 1929 to 1932 crash that America experienced, or the crash in 32, the bank runs and all that stuff. So that's what's going on in my mind right now. This could potentially happen with the bail-in situation. This could be the deflationary head fake that I'm talking about. I just want to show you one last thing before I end this. Alright, this is some paperwork that I showed you from my old employer. We used to deal with paper companies, and the thing is that we got pricing from this company, right? And here's the deal. These were the prices in 2010, and the old company that I worked for, right? We used to just sell them paper, and they used to send it to China and etc. So if you look at these prices from 2010, they were, if you look at just this paper, 480. This showed that, number one, the prices were a lot more than where they were before I left this company. And just look at these prices. 480 price per ton for paper, for baled hard white. Hard white paper, 450. And list goes on and on. We used to sell to China. Okay, now let's look at where it is right before I left the company. Okay, what I showed you before was June 2010. Now this is July 2013. And if you look at the prices like went down significantly. Like the baled hard white paper is $245. So what does it mean? It means that the economy was on the verge of going down, right? We had market prices saying that, you know what, there's a slowdown going on all over the world, and the Chinese buyers, well, they were asking for less money. So this is the problem that's going on. We've had disinflation going on, and that's the issue. And what I see happening, probably a deflationary head fake. Anyways, thanks for listening to me, guys. Talk to you another time. Bye.